Okay, so remember what I mentioned about evaluation model? I said it's fair value or revalued amount, deduct your subsequent accumulated depreciation, then the accumulated impairment losses. So listen up. Now, you will see that under the revaluation model, the first thing here is fair value or revalued amount, which means that here we are not using costs. What we are using is the fair value. And what fair value means basically is the market value of the asset or the selling price of that asset. That if I get to the market today, how much can I sell this asset? The same thing as the revalued amount. What this means is that, that means at the end of the year, we would have to get the fair value of these assets. We have to get the selling price of these assets. So this will require much more effort. Now, the next one is this subsequent accumulated depreciation. I would explain soon why they call it subsequent. And of course, this one, we're not going to look at it yet. Apart from that is this. The first thing is that, you see, this carrying amount, if an entity is using a revaluation model, the aim, the reason why they are using evaluation model is that they want this carrying amount to be very close, to be very what? Close to its market value or to its fair value. So that when we check our books for these assets, whatever figure we see there in respect of the value of these assets should be a representation of the current value of that asset today or the market value of that asset today. That's one about evaluation model. It's only when you want the value of your asset to reflect the market value, then you use evaluation model. The second thing is this. This evaluation model will require an entity going to market, going to know what is the market value of this asset. And there are some assets, like building, for example, now, you can't get, which market do you want to go to ask how much are they selling it? So there are some assets where you have to call in an external consultant or a valuer to come and value it. And it's not for free. You will pay them. So are you going to be doing that every year, or what's the frequency? So IAS 16 said that. See, the frequency of doing this revaluation, he said it depends on the volatility of the value of the asset. And do you know what I mean by volatility? The changes in the value of the asset. So if it is an asset that is highly volatile, whose value changes frequently, then you might have to be doing the revaluation every year. But if it is less volatile, that is, its value does not change every year, then you might be looking at maybe every 3 years or every 5 years. So by implication, the standard did not specify the frequency. It has attached it to the volatility in the value of the asset. So it is now left to you, the entity or the accountant, to determine which asset is volatile and which is not. That's the second thing about revaluation model. The third thing is this. Revaluation model or revaluation is carried out on a class by class basis. It's carried out on a what? Class by class basis. What do I mean by that? When you have motor vehicle in the books and there's an amount attached to it, that does not mean the entity has one motor vehicle. They could have 50. But what we have done is that we have added everything together from our fixed asset register to get a singular figure. Then we call it motor vehicle. They could have 50. So what we are saying is this. You cannot use the valuation model on a set of motor vehicle and use another model for another set. Okay, so when you use the valuation model for a motor vehicle, a single one, that means all the motor vehicles, you must also apply what? Evaluation model. All the motor vehicles. So if you have furniture and fittings, if you have plenty, the revaluation model must be done for all your furniture and fittings. But if you wish, you could use revaluation model for all your furniture and fittings and use cost model for all your motor vehicle. What is important to us is that whatever you are doing for a singular asset, all the other assets in that same class, you must use evaluation model for them. So that's the third thing about evaluation model. It is done on a class by class basis. See, these 3 points I've given you are extremely important when you are explaining evaluation model. So if an examiner asks you, which I've done before, that you should explain evaluation model, yes, you will give them this. The evaluation model is fair value or revalued amount minus what? Subsequent accumulated depreciation minus accumulated impairment losses. You need to explain those 3 points. You need to remember it. One is that when the aim of using evaluation model is to ensure that the carrying amount of the asset is very close to its market value. That's the first one. The carrying amount is very close. That's the aim. That is why an entity will want to use evaluation model, because the stress is too much to use evaluation model. You spend much more money than using the cost model. That's the first one. The second, the second issue about evaluation model is that the frequency of revaluation depends on the volatility in the value of the assets. Depends on what? The volatility in the value of the asset. The frequency of revaluation depends in the volatility of the value of the asset. And the third one is that the evaluation model is done on a class by class basis. Okay, so that's the background knowledge or theoretical background around revaluation model. Now, let's look at the mathematical framework or the accounting framework. So please pay close attention to this, like close attention. And if you have any question, you can free to interrupt me anytime. Anytime, I'm okay. Okay, so listen up. Let's work with a scenario, right? So let's say an entity acquired an asset on 1st January 2018. Let's say the asset it acquired was plant and machinery, and the cost of the asset it acquired was 150,000. The useful life of these assets, let's say, is 15 years. Let's say the useful life is 15 years. And the question now say that on 1st January 2023, they revalued the assets. When they tell you that, it means that the entity uses a revaluation model. Because subsequent measurement, there are 2 choices. When you choose one, you can't change. You can't. It's an accounting policy. When we teach you IAS 8, you will see that accounting policy, when you choose, you can't change it. You see, there are only 2 instances that IAS 1 mentioned and even IAS 8 mentioned where you can change your accounting policy. 2 instances. Number 1 is that when there is a change in accounting standard. So if an accounting standard change and you just want to comply, that is when you can change your accounting policy, or if it will result in relevant and faithful representation of that item. Those are the only 2 instances. Otherwise, you can't. Okay, so if they tell you that on 4th January 2023, the fair value of these assets is 120,000, it means that this entity uses evaluation model. Now, when I asked, of course, since we're in 2023, they will tell you that you should calculate the depreciation and the carrying amount of these assets at the end of 2023. Okay, so let me use this to teach you. See, whenever you have something like this, the first thing that should come to your mind is that, okay, this asset has been revalued. And when an asset has been revalued, one thing is sure to happen. One thing is sure to happen. There would either be a revaluation surplus or a revaluation deficit. That one is sacrosanct. It will happen. But your responsibility is to calculate it. And to calculate it is also very straightforward. All you just need to do is to compare the now market value, which in this case is called fair value. You compare it with your book value, which we have been calling what? The carrying amount. That you have to always do that. You have to always do that. Okay, so now let's determine our carrying amount then, because they already gave us fair value. And how do you get carrying amount? Is the cost. In this case, how much is the cost? You deduct what? See, what I'm doing is at which date? Not 2018, no, 2023. At the date where the revaluation occur. That date, I have to determine a revaluation surplus or a revaluation what? Deficits. Okay, this is the date that concerns us. So now let's calculate the carrying amount at this date. The cost is 150,000. So my question to you is this. What is the accumulated depreciation on this asset at 1st January 2023? 2023. 30,000. Okay, we have 30,000. Any other answers? We have 30,000. The accumulated depreciation. 60,000. 60,000. 60,000. We have 60,000. I need one more answer. 60,000. So I think that a lot of you guys are going for 60,000. So let's check if you are correct, right? Okay. So, of course, they have given us useful life. That means the depreciation per annum is simply going to be 150,000 divided by how much? 15 years. So that means they'll be charging how much per annum? 10,000 per annum. So let's count from 2018 to 1st January 2023. Let's count how many years? 2018, 2019, 2020, 2021, 2022. That's how many years? 5 years. So what is 10,000 times 5? Oh, not 60. Oh, it's 50. So are you correct? Sorry? How would you use December? This is January. Okay, so you'll have gotten it, Abby? Okay, I trust you. Okay, please don't get it wrong again. Never again. Okay, so 100,000 is our carrying amount. Okay, so in the exam, the examiner might be magnanimous to give you this carrying amount straight on. In fact, that's what they do in most instances. That's what they do. They will give you carrying amount. So you have to go through this process of determining it. Okay? In some other question, which is more common, they will give you the costs. And they will have given you the accumulated depreciation till the date of revaluation. So you have to still calculate the accumulated. You just need to do cost minus what? To get carrying amount. That is what you will find in most instances. But in some other instances, they could give you the breakdown like this. So you just have to figure it out yourself. So this is the most extreme instance you'll find in an exam. Okay? Okay, so we have the carrying amount. All we just need to do is to compare it with his what? With the fair value. Which is how much? 120,000. Now, there's a difference of how much? Now, to you, in the books, the value of this P&M is 100,000, plant and machinery, while the fair value is 120,000. Should that be a gain or a loss? It's a gain. So we call it revaluation surplus. So let me start with surplus. Let me explain surplus, then I will get to loss very soon. So let me take this figure up here. So we have a revaluation surplus of how much? 20,000. You see, accounting is about two entries. We don't clean because as it is today, how much is in our books? 100,000. So we don't clean and replace. You pass two entry in reporting. So this 20,000 now, the aim is that we need to increase whatever is in our books from this figure to this figure. So how do we do that? How do we increase it? So I need somebody to tell me what we are going to debit and what we are going to credit. Mr. Omar, your first attempt.
Already the asset has a debit entry of 100,000.
Okay.
Then if you want to increase it, you have to credit that asset account with 100,000 and debit revaluation surplus account
With how much?
with the same 100,000.
Okay, not bad. That's a good attempt. Any other attempt? Gloria, you want to try? Quick. Give it a shot. How do you increase this asset from 100,000 to 120,000?
I believe we will debit is it P and L? I'm not sure with the amount.
Okay, she's not sure. Any other attempt? Right. Take. So how do you increase 100,000 to 120,000?
Okay, you have to debit your plant and machinery account and then credit valuation surplus.
Thank you very much. It's correct. With how much?
20,000.
Yes, and that's correct. You just mentioned it. If you want to increase assets, you debit it. Any increase in assets is debited. So you debit your P&L with how much? You credit an account called what? With how much? You see, while this one is in the statement of financial position, Abi, assets, why would this one be? OCI. Who said OCI? Unisa, you said OCI. Why OCI? Yes, it is an income. Yes, it is an income. I was expecting P&L, but you said OCI. Hold on. So why did you say OCI?
Because it's additional income. That's why it's coming to OCI.
Okay, if it's an additional income, then you should go to P&L. If it's an additional income. You see, I've mentioned this before in this class. Yes, this revaluation surplus is an income, but this type of income is an income that is not from the economic activities of the entity. It is only a market advantage. Therefore, it can reverse anytime. The fair value went up today, the next day it could go down. So it's not something we want to put in our P&L because anything you put in your P&L will constitute part of your profits that is available for distribution to your shareholders, and you don't want to do that. If it should reverse, is a problem. So those kind of income that are reversible, we call it unrealized income or an unrealized gain. And such income goes to other comprehensive income. We just put it there. So we see it as a reserve. We see it as a what? Reserve. So you see this revaluation surplus, it doesn't go to P&L, but it goes to where? OCI. OCI. So when you are preparing your statement of profit or loss and other comprehensive income, this is what goes to that OCI, revaluation surplus, that happened in that year. However, since this is a reserve, all the items in your evaluation surplus that happen in the current year, everything are taken to where? Statement of changes in equity. So you see, this amount will eventually end up where? In equity, where it will be carried forward. Where it will be carried forward. And the essence of carrying it forward is that by the time it reversed, any day it reversed, the account is still there, that we can simply what? Reduce it or remove it, as the case may be, because it can reverse. So we never want to attribute it to a year income or to a year profit. We want to carry it forward. We are waiting for it to what? Reverse. So all items of OCI goes to where? Equity. Where it will be carried forward, carried forward, carried forward, carried forward, carried forward. So that's why whenever you see revaluation reserve in the trial balance, you should know that these are surplus from the previous year, because you get to carry them forward forever. Though it's not forever, we'll still get to the limit today. Now, do you understand this? Okay, so this is what you find almost everywhere. But if you look at it closely, you see that there's something wrong with this. There's something wrong with this. So this is okay for your exam. Debit plant and machinery, credits OCI or equity, as the case may be. This is just very good for your exam. It's okay. But this is technically not totally okay. Especially here. Plant and machinery. We say we should debit plant and machinery 20,000, meaning that you want to increase your asset from 100,000 to what? But you know that the reality is this. There is no account harboring this 100,000 as a single account. This cost account is a separate account. This accumulated depreciation account is a separate account. They are separate accounts. This one I just did here is usually done in a fixed asset schedule. That is when you do the deduction. But on the account level, the asset account, this is what you find there. Cost. It's always at cost. It doesn't change. This is what you find there. In the accumulated depreciation account, this is what you find there. But we are saying that we want to increase our asset by 100,000. So if you find yourself doing this in practice, you have few issues, because which account exactly are you going to be debiting? Which account are you going to be debiting? That's the challenge. So I'll try and explain it. If you understand it, it's okay. If you don't understand it, it's also okay. It doesn't really matter. I'll just tell you what you should not forget. So, you see, usually, you don't just debit the asset account with the revaluation surplus amount. No. There are two things involved. There are two things that are affecting this. One is this, and the second is what? This. Those two must be impacted. The first one is this. What is in your asset account is how much? It's always at cost. 150,000. It doesn't change. You see, one of the things that will change it is when there is a revaluation of the asset. Is when there is a what? Revaluation of the assets, which is what we are discussing today. So, you see, when we say that the fair value of this asset has changed to how much? What it means is that please update the asset account to how much? 120,000. That's what it means. Therefore, what you are actually updating is how much? 150. And for me to update it to 120, it means I have to reduce it from 150 to how much? And if I want to reduce it, what will I do? I'll credit that asset account with how much? With 30,000. You see, this singular action will have corrected it, will have updated my asset account to how much? 120. So my asset account is now reflecting the new fair value, which is what we want, 120,000. Now, when you do that, the second thing is this. Whenever there is a revaluation of an asset, we see it as a rebirth of that asset. We see it as we are starting over again. For that reason, all of the accumulated depreciation on that asset till the date of revaluation, I repeat, all of the accumulated depreciation on that asset till when? Till the date of revaluation must be eliminated. Must be what? Eliminated. And to eliminate accumulated depreciation, knowing that accumulated depreciation always have a credit balance, is always credited. If you want to eliminate it, what do? You debit it. So we simply debit the accumulated depreciation with anything there as at that date. And as at 1st January 2023, how much was in our accumulated depreciation account? 50,000. You debit it with how much? 50,000. If you cumulate these two, you are still going to be having a net debit of how much? Of 20,000. So it's still okay. But you see, on a more deeper side, this is what happened on the back end. If you don't understand this, it's okay. It's okay. Right? It's okay. But you just need to be able to explain it. You just need to be able to explain it. If you can't remember the debit, this, credit, this. You see, three things are involved here. Three things are involved that I need you to know. Number one is that when you do a revaluation, it will result in either a revaluation surplus or a revaluation deficit. And the singular way in which it's calculated is by comparing the carrying amount of the asset with its what? Fair value. That's the first thing. That you always be required to do. And know that that revaluation surplus goes to where? OCI. That one is sacrosanct. The second thing I need you to know is that whenever there is a revaluation, all of the accumulated depreciation on that asset till the date of revaluation will be what? Eliminated. Know that it's going to be eliminated. It will be no more. So if you even don't remember the double entry, it's okay. You won't fail the exam. If you remember that, the accumulated depreciation has been what? Eliminated one way or the other. And the third thing is this. The third thing is that our asset accounts would now have been updated to the new market value. It will have been updated to the what? New market value. So if you can remember those 3 points, it's fine. But if you want to be a solid accountant, know this. Know this. Right? So, but for your exam, it doesn't really, they don't really go this deep in your exam, really. You will see, they don't go that deep. So what the examiner will just want you to do is just calculate evaluation surplus. That's it. They just want you to take it to OCI and move on. Okay? I've never seen a scenario where you have to update this, update that, no. But it's good you know it. Okay. Let's take a deep breath for now and ask questions.
So my question is that when we credit the asset account, so where is the corresponding debit going to? The corresponding 30,000 naira debit.
Unfortunately, there is no corresponding. This is like a complex debit and credit situation. See, what you have done in essence is that you have debited accumulated depreciation with 50,000. You have credited assets with 30,000, and you have credited revaluation surplus with 20,000. So debit credit balances off. Yes, that's what you have done in essence. See, the summary of this is that this thing is that you have debited accum depreciation with how much? 50,000. You have credited the assets with how much? You have credited evaluation surplus with how much? So 50-50 balances off. Right. So, but you see, before I even started this journey explaining this one, I already told you that in most textbooks, really, what you will see them saying is that debit assets with the evaluation surplus and credit equity. That's what you see them saying. Okay, but it's really more than that, sincerely. I will have done that and walk away, but I want to do much more. So you'll be fine with this. But I mean, you need to understand why we have subsequent. You see, when we say subsequent, it means that whatever depreciation we had before had been what? Eliminated. Had been eliminated. That's why they say subsequent. It's like starting over again. So it's the one we have done before, please take it out. Take it out. And this is how it's actually done. Debiting the accumulated depreciation and crediting the asset. So a lot of things, by the time you practice questions, you are going to get familiar with them. Gloria, take this.
If we want to do this in published account,
Okay.
and we've given the cost and given the accumulated depreciation and revalued amount, does it mean that we will use the revalued amount and leave the
Yes,
and
that's
leave
what
the
we'll do. Yeah, talking about when you want to calculate depreciation. Yes, of course. Which is where I'm going now. We don't use the cost again. Which is where I'm going now. The valued amount. Yes. Which is where I'm going now.
Depreciation now, is it going to be that same 15 years on the 120, or how do we?
Exactly. That's where I'm going now. Okay. So I've achieved one thing. Look up. I've achieved one thing. That is, on the date of revaluation, please you have to remember this, that whenever there is revaluation, on the date of revaluation, when on the date of revaluation, you have to calculate either a revaluation surplus or what? Deficit, which is what we have done here. And this is a double entry. Just we have done here. So we are done with that. Now, at the end of the year, which is 31st December, when? 2023, at the end of the year, then we need to calculate our what? Our depreciation for the year. Depreciation is simply costs all upon the what? Useful life. But this one now, we are starting over again. So, since now the new costs is now the what? The fair value or the revalued amount. Okay, so we are starting from this date of revaluation, 4th January 2023. And at that date, how many years do we have remaining? 10 years. We have 10 years because we bought the asset in 2018. But we counted it. We counted 5 years. That's been used up to this date. So 5 years from 15 years will remain how many years? 10 years. So 10 years remaining. And this is how you calculate your depreciation. So it's simply going to be, what's now the fair value? Divided by how many years? So how much is now our depreciation per annum? So that means 2023, 2024, 2025, 2026, till the end of the useful life. How much are we going to be charging? 12,000. Then what will be our carrying amount? This will go to P&L, Abi. What will go to the statement of financial position? Is going to be the cost or the fair value, Abi, in this case, which is how much? Deduct what? The subsequent what? Which is how much? 12,000. Then the carrying amount is how much? This will go to my statement of financial position. And it ends there. And it ends there, really. Yes.
if I get you right, it means the subsequent depreciation has nothing to do with the cost.
The initial cost, you mean?
Yes,
Yes, it has.
it's
Not
only the fair value.
It's only the fair value.
Okay.
Okay. Further questions, please. John, any question? It's fine. My friend, stop coming late. Oh, yeah, ask me your question. Yeah. Hold on, hold on. I mean, the word should enjoy your question.
The revaluation now, the gain, we are carrying it to OCI. Now, in a case whereby is an impairment, acute impairment, we instantly recognize it on the POL. Why is there something like that? And both of them depends on market value.
Okay, so that's not the case. It's not all impairment loss that immediately recognized to OCI. It's only to the extent that there is no existing evaluation surplus. Okay, I don't want to go deeper because I've not done IAS 36. But I'll still touch on impairment loss, which is a bit similar to evaluation deficit. You see, impairment loss is treated almost the same way as we treat evaluation deficit. So it doesn't go to P&L directly. It goes to P&L to the extent that there is no earlier surplus. If there are earlier surplus, it goes to OCI first. Good question, as usual. I mean, I'm just contemplating it, whether I should mention this, whether I should not mention it. I should mention it. Okay, since you think you are confident enough. Okay, this is a final thing, final principle here, I promise. So now, if you look very closely at this, if you look very closely, something is happening here. In the first 5 years, our annual depreciation was how much? Was 10,000 naira per annum. 150,000 divided by 15 years. Abi? But as a result of evaluation, our annual depreciation has increased to how much? 12,000. IAS 16 said that if an entity chooses, it can use this excess depreciation to earn its evaluation surplus. That is, if they choose, they can use the excess depreciation to do what? To earn the revaluation surplus. What do I mean? What do I mean by excess depreciation? You see, this is optional in the sense that you never do it in an exam. You never, unless the examiner specifically tells you to do it. And the way they tell you is that they will tell you that it is the policy of the entity to earn or to transfer revaluation surplus to where? Retained earnings. Let me show you. So we call something excess depreciation. And this excess depreciation only arises where there is revaluation, whereby our depreciation amount every year has now what? Increased. Because it should not increase when you are using straight line method. It should be the same. But if it increases, then that means our old depreciation was how much? 10,000. And our new depreciation is now how much? So we have an excess depreciation of how much? 2,000. IAS 16 says that if an entity chooses, it's a matter of policy. If they choose, they can be earning their revaluation surplus. Remember, I told you that this revaluation surplus is on end. So they can be earning it with this 2,000 every year. Because now we have excess depreciation of 2,000 every year. So, and how do you earn it? Meaning you would transfer. Revaluation surplus is a credit balance. Transfer from it every year by debiting it with how much? 2,000 and transferring it where? Retained earnings. And these two items are items of equity. So it's just a reclassification in equity. If you look at it a bit closer again, you will see that while this total amount is 20,000, by the time you start earning it, 2,000 every year, and how many years we have remaining? 10 years. After 10 years, what do you think will happen to this balance? Nil. You see, the intention of that is this. We believe that after 10 years, the carrying amount of the asset will be what? Nil. We believe that the asset has exhausted its economic life and it should be written off our books. It will not make sense for us to have a revaluation surplus of 20,000 in our books while the related asset is not there anymore. Everything should have what? Left our books. So the way they want to do it is that it's better for you to start earning it as you are using it. Be earning the revaluation surplus. But don't earn it through P&L. Don't transfer it to P&L. Transfer it directly to where? Directly to retained earnings. The alternative way is this, because I said this is a choice. It's not compulsory that you do it. And in fact, you don't even do it in an exam. You don't go there, except the examiner specifically tells you that the entity has a policy of transferring evaluation surplus to where? Retained earnings. That is when you want to do this. The alternative way is this. If you are not transferring this amount every year to retained earnings, after 10 years, when you have finished using the assets, or when the asset has exhausted its useful life, that means that 20,000 will still be there. Because in equity, you keep carrying it forward. Then what do you do with it? You say that 20,000 lump sum, just transfer it to where? Retained earnings. Transfer it to where? Retained earnings. Which we don't really advise in reporting because that's against the accrual concept. We don't like doing things one-off because we see that as mismatch. We see it as accounting manipulation, and it's something we don't support. So really, this is what is supported. Earning the revaluation surplus through your what? Retained earnings. Again, like I usually say, see, I try to narrow you down to your exam. I know what they will ask you, and I know what they won't ask you. So again, if you don't understand what I've just said, it's okay. It doesn't really affect you passing or failing. It doesn't affect it. But if you know it, it makes you a better accountant. So it's okay. And another thing I've mentioned this statement on is this one too, right? So those are just the two gray areas that even if you don't understand it deep down, you are still very much okay. But as a practicing accountant, one way or the other, you still have to know it. Still have to know it. Okay, so this is all about revaluation. Every other thing I'm going to be mentioning now, just a piece of cake. It won't really pose any brain threats. You don't have any challenge in understanding it. So any questions? Okay. Trying to remember your name now.
It's not important.
Okay.
Okay, so if you have a revaluation deficit, where does it go to in P&L?
Okay. Good question. So she said if you had a revaluation deficit, you can guess that would be a loss, Abi? And if you remember conceptual framework, when conceptual framework was explaining prudence, he said that care must be exercised in situation of uncertainty when making judgment under situation of uncertainty. And if you check your notes, the way I explained that to you was that when you are recognizing income and assets, you have to be very slow. You have to be care must be taken. You have to be slow in recognition of income and asset. But all known losses, all foreseeable expenses or losses must be immediately what? Recognized. That will apply for evaluation deficits. Even though it is unearned, even though we have not really incurred any loss, but at least there is a loss, take it to P&L. You take it to where? P&L. However, if there is a previous revaluation surplus on the same assets, like we have here now, if in the next year we now add a deficit, that means there is a surplus we are bringing from the previous year. Then in that case, you have to net off that surplus what? First. You have to net it off first. So that means that evaluation surplus will not go to P&L. Where will it go? OCI. So that is the only situation where evaluation deficit will not go to P&L. If there is a previous surplus, then it will have to go to OCI. You see, from what I've explained now, which I will demonstrate very soon, from what I've explained now, it means that if in this first year, instead of a surplus, if what we had was a deficit, being the first year revaluation occurred, where do you think this deficit will have gone? P&L. It will have gone directly to where? P&L. Since there was no previous surplus. If deficit happened, if that was the first deficit that occurred, take it to P&L straight. And from what he asked, that revaluation deficit is almost synonymous to impairment loss. It goes to P&L. But if in the next year, let's say we had a deficit of 20,000 this year. In the next year, we now had a surplus of 25,000. A revaluation surplus of 25,000. Again, that revaluation surplus, you will not take it to OCI because there was a previous what? Deficit. So that means that revaluation surplus only goes to OCI to the extent of that there is no previous deficit. If there was a previous deficit, where will it go? POL. He has to go and net off that deficit first. So if in the next year, in the first year we had a surplus of 20,000. In the next year, we now had a surplus of 25,000. The way that will work is that the first leg of that 25,000 will go to where? P&L. So 20,000 will net off that previous deficit. The amount that will now go to OCI is how much? 5,000. So they have to net off each other. You have to look at what is happening. You need to understand that. So surplus is only to the extent of deficit. It can only go to OCI where there is no deficit. If there is deficit, it goes to where? P&L. But the P&L is only to the extent of that what? Deficit. Any excess amount above that deficit will go to where? OCI. The same thing as deficit. If you have a deficit, it's a loss. It should go to where? P&L. But you cannot just go to P&L. You need to check. Was there any surplus before? If there was surplus before, it has to go to where? OCI. It has to go to OCI. Okay, so you are going to find it in your exam. And the way you find it is this. When the examiner gives you, it was there last night. When the examiner gives you evaluation reserve in the trial balance, and the evaluation reserve is on the credit side, it means that from the previous years, we have been bringing forward the what? A reserve of a surplus of that amount, if it's on the credit side. So if you now calculate this year, you now calculate a deficit, you should know that that deficit will go to where? OCI. It has to go to where? OCI, just to net off that surplus. Go to OCI, and you know that by the time from OCI, it will now go to equity to go and remove that surplus. We will see it, we will solve it, see it in action. That's how you have to do it. Again, if the question gives you a trial balance and they give you a revaluation reserve that is on the debit side, that's where? On the debit side. That means that there's a deficit from previous period, yes. So if you now calculate surplus this year, that surplus will not go to OCI. You have to be very careful. He has to go and net off that deficit first. So where will he go? P&L. This one is not something you cram, something you have to understand. Yes, that revaluation surplus goes to OCI to the extent that there is no previous deficit. If there is previous deficit, it goes to where? P&L. To go and cancel that one first. So if it now cancels it out and it is still remaining, then that remaining will now go to where? OCI. So it's just two ways. It's just two ways. Okay, so that is everything you need to know about revaluation. Everything. Please ask.
During evaluation,
Okay.
is it possible that you can also increase or reduce your estimated useful life?
Oh, definitely. So she said that during evaluation, is it possible to reduce or increase your useful life? Definitely. Definitely. All you all need to do is these 10 years that we use now, these 10 years we use in calculating your depreciation now, it should just be the revised useful life. You won't use 10 years again. It will just be the new useful life that you will have to use. Just be the revised useful life. Any other questions? Okay, so can we move forward? So with this, I'm done with evaluation. What is left is for us to now solve as many questions as possible. Many questions, many assignments as we can. Okay, so the final part of IAS 16 is derecognition. Is what? Derecognition. Okay, so let's look at derecognition of an item of PPE. If you look at this closely, we have touched on derecognition before in the conceptual framework. And you should know by now that derecognition means removal of an item from the books. Removal of an item from the books. So for derecognition in the case of PPE, one of the reasons why you have to remove from the books is where there is a what? Disposal of that item of PPE. Disposal of that item of what? PPE. And when there is disposal of an item of PPE, the first thing that will happen is that we are going to collect money. We are going to what? We are going to collect money. Let's say we collected 150,000, right? Do you think this should be revenue? We eventually recognize an asset from our books. So, like, we sold it. The money we collected, can it be revenue? It should be revenue, right? Not yet. Okay, is that one that will go to revenue? If it's income, it goes to revenue. No. So this one will not go to revenue. The money we receive. So last diet, they asked you a question about a company sold an asset. The money they receive, they put it in revenue. You know, all they just wanted to do is remove it from revenue. It is not revenue. Okay, this is just other income, right? But I will get there anyway. What I just need you to know is that the money we receive from the sales of an asset that we were using before is not what? Revenue. But not only that, like she was trying to make a point that when we sell, what will eventually become our income is not even this, because we spend a cost equaling the what? The carrying amount. right? Let's say that is 120,000. What is income or loss now to us is how much? Which we call what? And where does this one go? POL, other income. It goes to POL under other income. And in some situation, the examiner will tell you that you should treat it as part of admin. They will tell you. So that means you just go and, if it's gain, it will reduce your admin. If it is loss, you add it to your admin. Your admin is cost. So if you're not having a gain, an income, it will net off against that cost. But if it is a loss on disposal, it will add to your cost because it's also a loss. Okay. You see, your exam so far, this is all they want you to know. Really. This is all they want you to know. It's just for you to be able to calculate this gain on disposal. But there is more to it. There is more things you need to understand about this. So let's start from here. Let's start from here because one way or the other, we will have to remove something from our books as we have sold. So now this sales proceeds of 150 now, how do we put it in our books? This sales proceeds of 150,000, how do we put it in our books? So sales proceeds of how much? 150,000. You know that we will have received money equal to how much? 150,000. So when we have received money, are we debiting bank or credited bank? We are debiting bank. Abi? What do we credit? No, not the assets. We don't credit the assets with these sales proceeds. These sales proceeds. Well, it's other income, but we will call it an account called disposal account. With the what? With the sales proceeds. This is what you do. You go and put it in a disposal account. The second one is this carrying amount. By netting it off from here, you see, and it means that this carrying amount, we need to remove it from our books because we have sold the assets. And remember, there is no separate account called carrying amount. For carrying amount to have occurred, we will have two accounts, costs and what? Accumulated depreciation. So let's assume the cost is 160 and the accumulated depreciation is 40. I mean, it's just an assumption. That was what gave us 160 minus 40 gave us what? 120. So these are the separate accounts. So when we say we are removing carrying amount, it means we are removing the costs and we are also removing the what? Accumulated depreciation. So how do we remove costs? So the cost of the assets, we need to remove it. In this case, I'm saying is how much? And for us to remove an asset from our books, remember, assets will always have a debit balance. To remove it, we have to what? We have to credit the asset account. If you are crediting the asset account, I mean, from here, if sales proceed is going to disposal account, definitely this asset account is also go to where? So then I can go and net it off from there. So this is going to be with the cost of the what? With the cost of the asset. And finally, we also need to remove what again? The accumulated depreciation, which is how much? Which is 40,000. Accumulated depreciation account is a credit balance. If we want to remove it, what do? We debit it. So we debit the accumulated what? Depreciation account. It will go and meet where the cost is, which is where? And this will be with what? Accumulated depreciation. You will see that while the cost is on the debit side of the accumulated depreciation account, here, while the cost is on the debit side of the disposal account, the accumulated depreciation is on the credit side. So, by implication, they are netting off one another to get the what? The carrying amount. They are netting off. While this one is on the credit side of the disposal account. So, you see, what the disposal account is doing for us is this. So, which is why what your examiner just need you to know is just this. Hardly they have never require you to really know all of this, but you have to just understand this. This is pure reporting, okay? But for your exam, you can easily escape with this. That whenever there is a disposal, you know that yes, we are receiving money. Know that that money we are receiving is not revenue. Don't ever see it as revenue. That's one. Two, we are removing that asset from our books. We are removing the cost. We are removing the accumulated what? Depreciation. We are removing the asset from our books completely. And we are going to be getting a profit or loss on what? On disposal. That will go to P&L. Okay? But technically, this is how you do it. And as a matter of fact, most of accountants that have helped companies to recruit, this is what I always ask them. Most of ACAs, and most of them, there are few that have gotten, most of them will always flop with this. That, okay, they sold an asset, one of the item of PPE. How do you treat that in your books? What's that? So this is extremely important as an accountant. When you sell an asset, you need to know this principle. And really, that is it for PPE. So we still have like almost an hour to solve questions. So let's open our pack. Although we are using old pack. I'm collecting new pack. I've changed some things there. No. We are working diet in, diet out. If you come next diet, a lot of things will have changed. Yeah? Yes. So that means it will be nil. That means whatever it is you are selling it is the profit.
No, I don't mean we are selling. Just normal depreciation.
Oh, okay. Let me structure your question properly so that we can also benefit. It's saying that you have an asset, and at the end of its useful life, the carrying amount to be zero, right? So, but you are still using the asset. The asset is still actively in use, but the carrying amount is zero. So usually, accountants don't do anything; they will just leave it. But auditors, when auditor goes in, what do you do? What do you think you should do? She said you revalue it, which makes sense. But again, that will only be possible if you are using a revaluation model. If you are using a cost model, what do you say? That's correct. That's what you do. You just need to revise the useful life. That means your initial estimate of useful life is wrong. It can be wrong because it's an estimate, anyways. So when that situation happens, a lot of people will just leave it there as zero, and you are still using it. No, you revise it. It's now you extend it by another 2 years, or by another 3 years, or whatever it is that you want to revise it with. Not revaluing it. You can only do that if you are using a revaluation model. Okay, let's go to our practice questions. Quite a number of you submitted your assignments this week, which is very good. Should keep it up. So those that did not submit, know that you are wrong. Let's go to page 52. Page 52. Slami, I know you did not submit. Better start submitting your assignments. Let's go to page 52. Page 52. So We have done question 1 last week. We did question 1 last week. So we're going to start from question 2. We'll start from question 2. Are you all there?
Take the question.
Are we all ready? Okay, Sam, read the question, please.
Okay. I-16 requires a revaluation surplus resulting from initial revaluation of PPE to be treated in one of the following ways. A. Credited to long-term provisions and added to the PPE. B. Released to the income statement over the life of the PPE. C. Debited to the class of PPE that is being revalued and credited to equity. D. Credited to equity.
Okay. What's the answer? Sam, what's the answer?
Financial revaluation of
What's it? C. Yes, that's the correct answer. The answer is C. You debit the PP that is being revalued and credit what? Equity. That's the answer. Debit assets and credit equity. Yeah, but I've not even cleaned it. It's on the board now. Debit the assets, credit the revaluation surplus. That ends up in equity. Okay, so you can mark your answer so that you for your revision. Have we done question 3? No, we have not. So Sam, read question 3.
Okay. An entity has a policy of revaluing its PPE. An asset cost 15 million naira on 1st January 2008, has a useful life of 15 years, and is depreciated on a straight line basis to a zero residual value. The value of the assets at the 31st December 2008 was 14.5 million naira. At 31st December 2009, the market value of the assets was 12.5 million naira. The accounting entry at 31st December 2009 would be A. Depreciation 1.04 million to income statement, fall in value of 500,000 charged to revaluation reserve, and 0.46 million to the income statement. B. Depreciation 1.4 million naira, 1.04 million naira to income statement, fall in value of 960,000 naira charged to revaluation reserve. C. Depreciation 1 million naira to income statement, fall in value of 500,000 naira charged to revaluation reserve, and 500,000 to the income statement. D. Depreciation 1 million naira to income statement, fall in value of 960 million to other 960,000 to the other income statement.
That's a calculate. This kind of question should not even be multiple choice. It should be like 15 marks. So if you look at this question, they said the entity has a policy of revaluing their PPE. That means they use a revaluation model. Abi? So I think from here they bought the asset when, and what was the cost of the asset? For expressiveness, let me do like this. This is the same thing as 15 million. Okay. What's the useful life of the assets? Do we have residual value? No. Okay. So I don't even need to ask the method of depreciation because I will know it's straight line since they gave us useful life. But did they tell us the method of depreciation? Straight line, right? Okay. So let's set to 2020, 2008 before we go to 2009. So that means at the end of 2008, our depreciation is simply the cost minus residual value, which is 0, divided by the what? So that means depreciation per annum is how much? 1 million naira per annum. That means the carrying amount is going to be the cost, which is how much? Minus the accumulated depreciation, which is how much? So that means the carrying amount is how much? It's 14 million. So why this one goes to P&L for this year? Where will this one go? Statement of financial position for this year. This is 2008. So what happened in 2009? 2009, they told us they revalue the assets. No, is that 2009 or 2008? 31st December 2008, Abi, they revalue the assets. So there is a fair value of how much? 14.5 million. That means in 2008, there is a surplus of how much? Where will this one go? It goes to OCI. That will end up where? In equity. Okay, so this additional thing that happened in 2008. In 2009, that means, did they do any other evaluation? When? Was it at the beginning or at the end of? It's very important. You need to know whether it's at the beginning or at the end. I will use this question to tell you the difference. But let's attend to this question first. So at the end, which is 31st December 2000 and what? 2009, the fair value is now how much? Is now 12.5 million. Abi? So at the end of 2009, what was the carrying amount? The carrying amount is simply going to be the cost minus accumulated depreciation. So what was the cost? No? 14.5. Because they have revalued it now. So let me just put or what? Or fair value. Which is now 14.5 million. So you have to be very careful when there's a revaluation. When you're now doing the carrying amount now, like you asked now, you ignore this cost now. You'll be working with the new what? New value. Extremely important. So we deduct what? Now the accumulated depreciation now is going to be the new cost over the remaining useful life, which is now how many years? 14 years. Abi? Because it was 15 years in the first year. In the second year, it's going to be how many years? So how much is this? One. Is it like this? So what's the carrying amount? 13. So if the carrying amount is 13,464 and the fair value is how much? Is this a deficit or surplus? So we'll have a revaluation deficit of how much? 964. So this 964, where will it go? Where will it go? Thank you very much. First leg will go to where? OCI. Why? Exactly, because to net off this surplus. Very good. If not for this surplus, the deficit will have gone to P&L. But because we had a surplus in the previous year, it has to net that one off first. So you debit OCI with how much? 500. So it's going to go to OCI to the extent of that surplus. It's still remaining 464. Where will that one go? P&L. Then the excess over that one can then go to where? And that's how much? Then what are we going to credit? The assets with how much? 900 and what? 64. So this was what I was trying to explain. That when there is a previous deficit, when there is a previous surplus, you now have a deficit in the next year. You don't, deficit, we know that it should go to P&L. But because there was a previous surplus, he has to net off that first. So that was why we net off this 500. Excess went to P&L. Then we then credited assets. This one will end up in equity, of course. This will just be a deduction. It is from equity, this evaluation surplus now to be a carry forward in equity. Under a statement of changes in equity, it will be balance brought forward 500. So this one will go and meet it there. From OCI to go and meet it in our equity as a deduction. In our equity, in our evaluation surplus. Yes, it has nilled it off. But I've told you that when you have deficit, ordinarily it should be a loss. It should go to P&L. You can only go to OCI to the extent of that surplus there. So you don't take everything to OCI. Take it to the extent of the previous year surplus. And the previous year surplus or the accumulated surplus is 500. So we are going to take it to the extent of the 500. The excess will still go to P&L, which is 464. So what you will net off is 500, not 964. Okay? It's just to the extent of that surplus. This question is not for everybody. Whoever is interested, based on what I've taught you now, this one I just said debit assets. I just said debit assets. In real terms, how do you really impact it in your books? It's okay to do like this, you can. But for those of you that are interested, how do you really impact it? Because it's not this that is going to your assets really. So who can give it a shot? How does it go? Who wants to try? Laura, you want to try? You want to try? Yeah, try. You credit the assets. Okay. With how much? Okay. Then what again? Okay. With how much? Okay, definitely. Who wants to try? Okay, so apparently none of you understood this. None of you understood it. But you were not even in class when I was explaining, or were you? Okay, yeah. Not even a single person understood it. Let me cover my camera. It's not easy to use old age to learn. It's very difficult. None of you understood it. None of you. So nobody can try. Okay. So whenever there is a revaluation, we know that we are going to eliminate our accumulated depreciation completely. So I know that this accumulated depreciation is going. So I need to debit it. With how much? It goes, it has to go. That's one. Two, I know that now that we have a new fair value of how much? 12,500. And what was in my asset account? 14,500. So that means I need to bring it down from this amount to this amount. That means I'm reducing my asset by how much? By 2,000. That means I need to credit my assets with how much? If you net these two, it's a net credit of 964. The net credit. So again, this is just an optional knowledge. If you need it, you take it. If you don't need it, you just leave it. Which I think is very obvious. That is what all of you did. You ignored it. Eshaja pass, Kamalo. It's okay. That one too is nice. Yes, now. This is it now. That one has been eliminated too now. Share this one. It has been eliminated too. I just didn't talk about that. As soon as we revalued an asset, the asset was revalued here. So accumulated depreciation has been eliminated. So there was nothing in our accumulated depreciation. So we are starting from a new slate here. So as at this date of revaluation, our accumulated depreciation was this. So whenever there's evaluation, remove it from your books. It's eliminated. That's one. Two, what you are increasing, what's in your cost account or your asset account is this. You're updating it to this. Okay? So this is a reduction. That means I'm crediting my assets with how much? With 2,000. It will net off. Everything will balance up. If you wish. Okay, but it doesn't really matter. It doesn't really matter at all. Yes. Because it came late now. Came late. And from this one already, you see, by eliminating depreciation whenever we revalue, it means that from the date of evaluation going forward, we are starting a new one. So that's why they say subsequent. Subsequent. Right? Which is what is being done here. Even if you look at this one too, ordinarily, this one was as soon as we revalued here, the accumulated depreciation, it didn't include this one because this one has been eliminated. So we are starting from the next year. So with this now, what's the correct answer? What's the correct answer? Can it be between C and what is the answer? He said A. Which one are you going for? He said A. Let's see A. A said we will depreciate 1.04 to income statement. And how much is our depreciation to income statement? 1.04. Abi? Okay. Then they said that there is a fall in value charged to revaluation reserve of 0.5. How much went to evaluation reserve through OCI? 500. Okay. Then 0.46 will go to income statement. How much went to income statement? P&L? 0.46. That's correct now. Let's see your C. Depreciate 1 million to, and it's not 1 million that went to, it's not C. These are very good questions.
So what about the B? So fall in value of 0.
So this one, a lot of people will have chosen this because they will not know that first evaluation deficit should not even go to OCI, it should go to P&L. That even if it's going to OCI, it should be the extent of that previous evaluation surplus. So this one just took everything to evaluation surplus. So that's wrong. These are good questions. Okay, let's go to the next question. Are you still writing? Okay. Can we continue? Okay. We have done question 4, haven't we? We did question 4 last week. Didn't we? We did not. Okay. And this is very similar to the assignment I gave you the other week. And what they say we should calculate, the machine costs. I mean, this is a very straightforward one. So I'll mark it as your assignment again. Go and attempt this. So question 5 again is a similar question, just to calculate the machine costs. Mark that one also as your assignment. Yes, please. 4 and 5 as your assignment. Mark it. Do you want to mark it? Okay, you're already writing it in your note. Now let's go to question 6. You can attempt that in class now. Yeah, read the question 6 for us. Yeah, Sam, read.
Okay. On March 1, 2022, Yuka and Co. purchased an upgrade package from Plant Co. at a cost of 18,000 naira. For the machine it originally purchased in 2010, the upgrade the upgrade work took a total of 2 days, where new components were added to the machine. Yuka agreed to purchase the upgrade package as the new component will lead to a reduction in production time per unit of 15%. This will enable Yuka to increase production without the need to purchase a new machine. Required: Explain whether the additional expenditure should be capitalized as part of PPE or expensed to the statement of profit or loss for the year ended 28 February 2023. Okay. Upgrade package. It should be capitalized. The upgrade on. Yeah. And the upgrade means they buy components of capital 18.
Sam, what's the answer?
It should be capitalized, sir.
Why?
Firstly, it increased their capacity of the components, the production machine, and also they purchase another part, I mean component of the asset.
That's correct. That's very correct. Yeah, that's correct. So is that straightforward? The other thing is that if they ask you something like this, what they ask you to do is to explain. Explain. So you have to explain properly. And the way you do that is first you have to state the principle that they ask you whether the additional expenditure, you need to let them know that this is a subsequent cost. And subsequent costs can only be capitalized if it meets the recognition criteria. That is, it must be probable that future economic benefits associated with the item will flow to the entity, and it must have a cost that can be measured reliably. That's the first criteria. You can then go ahead, and this means that that cost must improve the productive capacity of the assets, or it must increase the useful life of the assets. So if a question like this takes 5 marks, that principle alone that you have stated will give you almost 3 marks. Yeah, it gives you a lot of the marks. So when you have stated the principle, then you can then say, okay, from the case, we're told that the additional components would lead to a reduction in production time of by almost 15%, which will increase the production without the need for purchasing a new machine. Hence, this meets the recognition criteria and should be what? Should be capitalized. That's how you'll have gotten a good mark. But uh, I've not really seen I can asking you like this. They don't ask you like this. The way I can ask yours is a bit straightforward. They can ask you what's the recognition criteria for subsequent costs. So they don't want you to really reason that much. They want you to just come and give them the principle. So skills level is principle level, right? So a question like this is at corporate reporting. That's when they will ask you to advise, explain, discuss, okay? But you never can tell. They could ask you, remember that you state the principle, you apply it to the case, then you conclude, right? That's how you get your full marks there. So if you're interested, you can put it the way you understand using those 3 steps. Send it to me, then I'll send you the complete solution. But I need to see your attempt first. The question 6, please. I've just told you the solution. Okay, question 7, Sam. Question 7.
Okay. A machine was purchased on 1st April. Okay.
Okay,
Should I?
which one? Exactly. So it's either of the two. It's either it increases the productive capacity or it increases the useful life. It's not the two. Okay, and again, when you're talking about useful life in reporting, useful life is not just about the period over which you can use the asset. It's also the units that can be produced from the asset, or even the service hours, the number of hours the asset can be used. So this one is increasing or reducing the lead time. Is one way or the other also increasing the useful life.
Okay. A machine was purchased on 1st April 2010 for 120 naira, 120,000 naira. It was estimated that the asset had a residual value of 20,000 naira and a useful life of 10 years at this date. On 1st April 2012, the residual value was reassessed as being only 15,000 naira, and remaining useful life was considered to be only 5 years. Required: demonstrate how the machine should be accounted for in the years ended 31st March 2011, 2012, and 2013, and prepare extract of the statement of profit or loss statement and statement of financial position for each year.
Okay, so a question like this in your exam can be up to 10 marks. Your exam, as short as it is, these are a typical exam question that you find. So it's a very good question because two things happen. Yeah, they purchased the asset in 2000, April 2000. The residual value is 20 years. Useful life is 10 years. Then after 2 years, they reassess the residual value. They reassess the useful life. So it's a very good question. So let's look at it. Okay, so from this question now, they bought the assets when? 1st April 2000. Abi? And how much did they buy it? Did they give us the useful life? Did they give us the useful life? 10 years. And they gave us the residual value. To be how much? 20,000. So, and they told us what happened again. 1st April when? 2002. They reassessed the residual value to now be how much? And they also revised the useful life to be how much? Is this additional useful life or it is now 5 years? Okay, okay. So you have to be able to differentiate it that okay, the remaining life is now 5 years, or is this additional? So if it's additional, they will tell you that this increased it by, or this is additional. But this one, they say it is now 5 years. Okay, so let's see. And what the question requires you to do is to determine the depreciation and the carrying amount, and also prepare an extract of P&L and position statement for March 2021, March 2022, and March 2023. So let's do our workings first. So at March 2021 first, our depreciation, which is going to be cost minus residual value. The residual value is how much? Divided by what? Useful life. So what are we looking at? How much? So this is 10,000 naira per what? Per annum. So the carrying amount at March 2001, the carrying amount, what was the cost? What was the accumulated depreciation at this date? So the carrying amount is how much? 110,000. Abi? As at the end of 2000 2. What's the depreciation? As at the end of 2002, what's depreciation? What's depreciation? Is it on? I'm hearing 100,000. I'm hearing 10,000. How much is the depreciation? So the depreciation per annum is 10,000. Okay, because nothing has happened at this date. Something only happened after this date. Okay, so it's still 10,000. Since we have already calculated it here, so we don't have to calculate it again. So it's 10,000 naira per annum. So what's the carrying amount? The carrying amount is what's the cost? The cost does not change. But now, what is now the accumulated depreciation? Sorry? Is now 20. The accumulated depreciation is now 20. 10,000 in year 1, 10,000 in year 2. So 2 years is now 20,000. So the carrying amount is how much? The carrying amount at the end of year 2 is now how much? 100,000. So in year 3, in fact, before the end of year 3, something happened on this date. On these dates, they change the residual value, they change the what again? So at the end of the year, so that means we have to reassess our depreciation. So our depreciation cannot be 10,000 again per annum because a lot of the variables has changed. Abi? So the way it's done is that you get what's the carrying amount as at this date minus the revised residual value minus the revised what? Useful life. Okay, so this is where a lot of students will have got it wrong. A lot of students, instead of them to use the carrying amount as at that date, they will go and use the costs. That is where a lot of students will have gotten it wrong. And this is where we will get almost the most of the marks in this question. So this one, you use the revised residual value, the revised useful life. So the carrying amount at this date is how much? What's the revised useful life? What's the revised useful life? So this is the revised residual value. So how much are we looking at? Sorry? This is 85,000 divided by 5 years. So this is going to be 17,000 per annum from this date going forward. Okay, it has changed. So let's prepare the statement as requested. So our statement of profit or loss, statement of profit or loss for the year ended, we have 3 years here. We have 31st March 2001. We have 31st March 2000 and what again? 2 and 31st March 2003. So what simply goes to our P&L is what? In year 1, depreciation is how much? In year 2 is 10,000. And in year 3 is how much? Year 3 is 17,000. And my statement of financial position as at What's my cost? Then my accumulated depreciation in year one is how much? Giving me my carrying amount to be how much? In year two, what's my accumulated depreciation? Making this to be how much? In year three, what's my accumulated depreciation? Making this to be how much? Okay, the question is short, but it has a lot to it. Thank you.